Hello, everyone. Dion Zakuski here, Branch Manager, Senior Wealth Advisor, and Portfolio Manager here at Scotia Wealth Management. And thanks for joining me for our latest video. In today's episode, we're going to do a bit of a combo, a bit of a hockey theme and Christmas theme. Here's our 3-period breakdown. First, we're going to give you a quick market update. Period 2 is we're going to look deeper into AI and technology. We're getting a lot of questions around this lately. Are we in a bubble, a correction, or is this a positive long-term trend? Period 3 will be strategy and what's next, and then we'll bring in Bond for a little bit of overtime, who's going to talk about some important year-end planning tips. So looking at the market update, markets have continued to push higher, although most of the scoring is still coming from the top line, which is basically some of the big mega cap technology names. Inflation continues to cool, just not as quickly as central banks would like. It's a bit like waiting for your Christmas lights to stop flickering. You know it's going to happen, you just don't know when. Interest rates have dropped a notch, corporate earnings are solid, and North American markets continue to show resilience. But valuations are stretched in certain pockets, and the market is skating with a little bit more edge than glide right now. When we look at that narrow leadership, we can look at a chart here that'll explain it further. Going back the last couple years, if we look at the US market being the red line, the S&P 500, we can see it's been a pretty steady increase. Although, compare that to the returns of the Magnificent Seven stocks, which are mainly the technology names of like Amazon, Apple, Google, and so on, along with semiconductors and the IT sector, and we can see technology has definitely outperformed. Which now takes me to period number 2, and this is AI and technology. Is this a bubble, a correction, or are we seeing a long-term trend? And this has become the number one question we've been getting lately, right up there with, can the Oilers ever learn how to play defense? I can't speak for the Oilers, and that's probably the toughest question there is. But I can tell you when it comes to technology, our leading strategists from Scotia have recently released an extensive white paper on the topic, and if you're interested, let us know. We'd be happy to forward a copy. It's pretty meaty, I'll warn you. It's 176 pages, but you'll be sure to wow your friends at the next Christmas party. To give you a summary of it, though, the first question is, are we in a bubble? And yes, there are a few similarities to the late 90s. Leadership is concentrated, valuations are a little bit elevated, and capital spending on infrastructure is exploding faster than kids ripping open their gifts on Christmas morning. But here's the big difference. Today's tech leaders aren't speculative startups with no revenue. They're profitable, cash-rich, established companies with real businesses and real competitive advantages. These aren't dot-com dreams, these are cash flow machines. What about those valuations, you ask? Well, let's look at a chart here. If we look at the average price earnings ratio, which is kind of a measure of whether a stock is cheap or expensive, going back the last 10 years or so, we can see that today's valuations, being the gray bars, are higher than where they were before. But look at that dotted line up top. We're still nowhere near where the sector peak price earnings were back in the dot-com era. So that leads us to our next question. Is this now a correction? We saw some market volatility through the month of October, but think of it as like a mid-game momentum shift. It doesn't mean the season is over, it just means our bench needs a breather. And lastly, is this a long-term trend? And this is where the evidence is most clear. AI is a capital deepening technology. Companies are investing heavily in data centers, semiconductors, power systems, and software. Historically, this kind of investment leads to higher productivity and higher corporate profitability, which means long-term support for the stock market. Now, short-term inflation may rise due to the cost of building out all this infrastructure, similar to the way your December electricity bill kind of spikes with all those lights up, right? But longer-term productivity gains are likely to be disinflationary once this technology is fully absorbed by the economy. Most importantly, advanced economies, especially the US and Canada, are best positioned to benefit first. We have the infrastructure, the talent, and the capital to make it happen. So to answer your question, yes, some parts of the market may look frothy, and we must avoid those small cap speculative tech names. But overall, we are seeing a long-term, multi-year technology cycle, not a short-lived bubble. So this brings me to the final period of strategy and what's next. How do we position portfolios heading to the new year with all this knowledge around AI, technology, and where markets are headed? Well, just like a hockey team needs more than one scoring line, a portfolio does need more than one winning sector. So we want exposure to tech, yes, but not in a way that the entire season depends on one superstar. It's the old diversification theme. Second, we want to maintain some balance with fixed income. You've heard me say this before, but bonds do offer some level of downside protection and income. This is like our defense in the portfolio. Third, don't forget about the physical side of the economy with artificial intelligence. Data centers need electricity. Electricity needs generation. Generation needs infrastructure. So we can look at the defensive side of the market as well, looking at sectors like utilities, pipelines, industrials, and real assets that will all be beneficiaries of this trend as well. Finally, stick to your plan. We know that tech and markets in general rarely move in straight lines. Historically, long-term investors who stay disciplined, diversified, and forward-thinking end up on the right side of the scoreboard. But this all comes back to the goals defined in your wealth plan. And if you want to update on your plan or need to redevelop it, please contact our team anytime. And speaking of wealth planning, let's now head into overtime and get Bond in here to talk about some year-end planning tips. Thanks for watching. Have a great holiday season.
On today's Did You Know segment, we're going to talk a little bit about year-end tax planning. As we get closer to year-end, it's worth giving your tax planning a once-over, especially if you're a higher income earner. On capital gains, the government canceled that planned increase to the inclusion rate, so we're still at 50%. If you're thinking about selling investments, compare your 2025 to 2026 tax brackets. If next year's going to be lower, you might want to save by waiting to sell those securities. Same with capital losses. Realizing them can help offset gains, so it's good to be strategic. And on that note, tax loss selling can be one of the simplest year-end wins. If you've got investments sitting in the red, crystallizing those losses can help cancel out gains this year or be carried back to previous years. Just watch that superficial loss rule. If you buy back the same security within 30 days, you lose that deduction. One workaround for that is by buying something similar but not identical so that you stay invested without breaking the rule. It's a nice way to tidy up your portfolio while trimming your tax bill. Charitable giving is still a great tax reducer, especially if you donate securities directly. If you have kids saving for their first home, the First Home Savings Account is a fantastic account. Tax deductible going in, tax-free coming out, so long as you use those funds to purchase a house, and worth considering before year end. If you're 65 or older, converting part of your RSP to a RIF could unlock a pension credit and save some tax. And parents and grandparents might want to top up their registered education savings plans before year end to grab any of their eligible education grant money. There are also new trust reporting rules. So if you hold assets jointly or have in trust for accounts for a child, you might be considered a trustee and need to file a T3. That's definitely one you want to check with your accountant. Please reach out to discuss your specific situation. Happy holidays to you and your family from all of us at the Zakuski Group.